Okay, the question was asked, how do you plan on expanding in the near to medium term?
Sure. So I think for us, it's getting more partners. It's finding more broker-dealer partners, wealth management firms, investment funds, even high-net-worth investors. But I often get asked the question that if you're a believer in this gold thesis, and you don't like the idea of counterparty risk, and you don't like the idea of the banking system and things of that nature, which I'm not completely against all of that. Why do you work with these broker-dealer firms? Why would you ever go to those firms? And I always come back with the answer: if people ever believe in a thesis, it will always be a really niche thesis if you just service the community that already knows about it. Mm-hmm. So if you're just selling gold to gold bugs, people already get it, you don't really do anything. You're just servicing the community that already gets it. Mm-hmm. What our model does is we're trying to bring it to the idea and concept to people who don't understand it. So we don't say, hey, put all your money in gold and you're great. We say have an allocation, and whether your allocation is 5% or 50%, we're not going to tell you what that is, but you'll figure that out. Our job is to educate on some of the issues that are out there, why our process is better, and you can only do that by going after these firms that work with the mass population. So, I probably you didn't even know this part of this interview, but one of the largest banks in the firm is one of our clients. Mm-hmm. Who would have thought a firm like that was in the heart of the credit crisis is selling physical gold to their clients in allocated bars in Zurich? Mm-hmm. No one would have dreamed of that a year or two ago. Mm-hmm. And if we can start that idea, and now every client that's bought from that actually understands what's happening, some of the aftermath, and why you want physical gold and things like that. And that's how you actually create a movement, and that's how you create change, by working with the establishment that already exists. Mm-hmm. It's very hard to change it when you're just talking to people who already get the idea and are cheering you on. It's trying to change people's minds or educate people who don't know anything about it. Mm-hmm. And so those are the kind of firms that we're going after, where it's not the traditional people who already buy it, but people who haven't been educated or don't know about it yet.
Okay. Are you taking equity investments directly for expansion?
No.
No? Okay. Closely held fund, I'm assuming, right?
Yes, that's management and a couple of private investors.
Okay. Background of the principals?
The principals like ourselves or investors. So
like yourselves.
My background was I actually started out in investment banking, doing mergers and acquisitions, and I worked at a large investment fund. And then started working with a couple of the other, I gotta call them seed or angel investors or private investors that work with us now, who are both independent investors who saw a lot of this stuff coming, and we put our minds together thinking of a way to do that. We're actually, the idea really came about because one of them was trying to buy physical gold, called his private banker, and they said the minimum for him is $20 million to buy. Mm-hmm. And he's a relatively well-known individual with means, and he couldn't do that. And then he started going online and didn't feel comfortable wiring money to some firm in some Caymans or the Jersey Islands, where he couldn't actually own the bar or ever visit it or ever get access to it.
Well, a 12-year-old in Jersey, which it could have very well been, right?
and so that's kind of actually how the idea was, why don't we create a way to do that? It shouldn't be limited to just the ultra high net worth. Mm-hmm.
Yeah, no, I think and just the overall process that we have is much different, and this is the reason why we're able to work with these large wealth management firms as opposed to people who have been in existence, online shops for years. They just don't have the safeguards in place to be able to work. And the educational-based model that we've got, from sales support to people just aren't used to the physical marketplace. It's a very foreign idea to people. So these guys that are managing mass amounts of wealth are using the GLDs of the world. And not to knock it, I think that GLD has its place in the marketplace, maybe more on a speculative basis. But long-term holds, people need to be educated on the benefits of physical ownership when you're taking away some of this counterparty risk, because over the long term, we don't know how things will play out.
It's very important.
So I think it's a different type solution. I think that, I also have a wealth management distribution background and understanding how to, educate advisors, and it's not for every client, but the clients that are of that higher net worth, it is resonating well with them. Mm-hmm. So we're having a lot of success in those types of channels.
Okay. I asked a lot of, I guess you could say hard-nosed questions, especially for the Goldbug audience, which I'm sure this video will hit. But personally, there's no question if I were to go the derivative route or physical. The derivative route is exactly that. And that's like me deriving the fact that I wish I had my gold back versus getting it back. So we asked you to compare and contrast with the Sprott Physical Asset Trust. Compare and contrast with the GLD and the ETFs.
Sure, it's a similar answer. I mean, when you're buying a share of a ETF, you're buying a share of a trust that's owns some gold. Particularly with large ETFs, some of whom you've named, part of the problem is you can never physically audit it, so you don't really know it's there. The largest ETF, in that one particularly, there's been 2 or 3 people that have ever seen it.
Don't be afraid to be
No,
the
so
largest.
GLD,
GLD is GLD.
The guys of GLD and Bob Pisani are the only people in the world who've ever seen the gold, right? Supposedly seen the gold. That's an odd.
You're saying only Bob Pisani and GLD seen the gold?
Yeah.
Okay.
Right. I mean, seriously, I think that they actually say that.
He's never told me he saw it, but.
But I'm sure that's right, right?
Yeah.
And so it's I find that odd for a vehicle that's supposed to create transparency, that if no one ever gets to physically check it out or audit it, or if you're a 5% holder of GLD, why shouldn't you be able to go check the asset out? And so I think that just creates enormous fear. The big thing that scared me personally from GLD and the other ETFs is the use of sub-custodians. So it's very clear in the prospectus that GLD is allowed to give their gold to sub-custodians to hold it on their behalf. And so not all of it has to be at one HSBC vault. It can be sent to different areas. The problem is when you have a sub-custodian, you can't really audit the sub-custodian properly because it's not you anymore. And I'm not a conspiracy theorist. I'm a capitalist. I believe if there's a capitalistic intent, there's always a capitalist intent in many bad decisions, and there's there's definitely the ability to make money on lending gold out and not having it there because it's a negative yielding asset. And so there's a.
I'm going to request you be a little more direct. You can say steal. You can say.
No, I mean if I'm a sub custodian of GLD and I'm getting like a few bips for holding the gold, you can make more money writing derivatives off it. You can write options off it. You can lend it out to people who can then go sell it to the market, just like the IMF and the central banks do. You can find ways to create more yield off a negative yielding asset by not having it there or having multiple claims on that asset.
Quick and diligent. So by doing that, they're in essence creating capital that wasn't there, or value that wasn't there from an economic perspective.
And the fact that you can settle as a future contract with GLD is almost like creating a CDO squared now. And
so they're printing.
Yeah, to some degree, and we don't know, right? It's impossible to ever know because it's unaudited, but in that sense, you can't it's not physically audited. It's not guaranteed to be insured. And if I'm particularly an institutional investor and I can buy the real asset or buy the ETF, I don't even, if there's a 1% risk, I'm not even going to take that 1% risk because we've seen that a 1% risk happens more often than people think. We saw Lehman, we saw Bear Stearns, we saw MF Global. It's no longer like, oh, it's never going to happen.
Only it's 100 instances, right?
Yeah, it happens, right? Yes. And so why ever take that risk?
So GLD, I'm not an expert in the area, but my first concern with GLD, again, is it's basically a derivative, and it's derivative without the ability of, like you say, examining the underlying. There's a strong risk that they may or may not be underlying, but I don't know. I've never read through the entire GLD prospectus. I didn't like the first few paragraphs, so I simply put it down. But the point that you bring up is significant. Let's suppose there is an event. I can't really call it, say, a black swan event because it's more like a white swan. It seems obvious.
Yeah.
But let's suppose GLD just get called on assets that it doesn't have or somehow is investigated, and they found that they've taken, $200 million of capital to cover $5 million of physical, which means, I don't want to say the word fraud, but let's say hypothetically fraud. What does that do to gold?
I think it makes gold skyrocket because when you're trying to cover for an asset that's not there, you have immediate buying. And, again, it's capitalistic, right? People are going to see that at higher offer prices out there and high prices, and I think there'll be a run. It's just like a run like on any other asset, and because GLD is not small anymore. I mean, it holds more gold than most countries, so
it's gathered more capital.
Yeah.
To say it's almost gold in most countries, you'd have to join Mr. Pisani, if I'm not mistaken, and see it, right? And I don't know, I don't know if you saw it or not, Mr. Pisani, but I'm just using you as a reference.
No, yeah, and so again, it could all be there. I have no clue, but
Right.
I would hedge out my own personal risk by always buying the physical if I had the same liquidity, which you can, and at a similar price, which you have.
Okay, well, I think that's it. Anything else before we go again?
That's good.
Okay. Expect